Welcome back. We're in the middle of a good conversation with Pierre Ouimet, head investment strategist at UBS Canada. Pierre, I told viewers before the break that you thought the Fed was behind the curve. In fact, your view is stronger than that. You used the phrase "way behind the curve." Talk to us about why you think the Fed should have cut by now.
Well, the big question in the U.S. is the labor market. And, it's been a pet peeve for me that Fed policy is set based on what's happening in the labor market. I mean, it has to be the most lagging of all lagging indicators. And yet they're using the labor market in order to set policy. I think that's absurd, quite honestly. I mean, I'm not on the FOMC, but, I don't think that's the way you should run policy. So, I think the labor market is slowing a lot more than the numbers seem to indicate. And we saw some numbers, the recent numbers in the U.S., you saw, again, massive revisions to previous months. And that's been kind of the telltale of what's happening in the labor market in the U.S. is that the first estimate is usually pretty good. And then you get these massive revisions. These revisions are twice what they were to pre-COVID. And that's because there are all sorts of delays in responding to the survey. But yet the market reacts to the headline number that comes out of the first Friday of the month. And I think that's another, unfortunately, it comes out to be a good number, which is revised later, and no one really pays attention to the revisions. I think the labor market is slowing. It's slowing a lot more than a lot of people think. You look at the National Federation of Independent Business, and you'll look at their hiring intentions. And also, part-time work has been soaring right now. And typically that happens prior to a recession as well. So the increase in part-time workers is worrisome. And also the NFIB surveys are worrisome as well. And you look at the employment components of the PMIs, they're also weakening as well. So I'm worried about the U.S. economy. And I think the Fed is... even if they cut rates, let's say by a quarter point in September, quite honestly, how much of an impact is that going to have? It probably won't have any impact at all because that won't be felt until the early part of 2026. And even a 0.25% is almost nothing. So I think they're whistling past the graveyard, and they should have started cutting rates a long time ago.
Okay, what are you expecting in second quarter earnings season? We've spoken to a couple of portfolio managers in the course of this program who think that the results from non-technology companies will be quite good and perhaps better than expected, and perhaps shine a spotlight on sections of the stock market that are undervalued.
Yeah, I agree. I think the non-tech part of the market, which was dismal last year, was actually missing in action totally. This year, we're starting to see some progress. I mean, initially maybe 3 to 4%, but as the quarters evolve, of course, the comparisons on a year-over-year basis. Last year was a poor year, so the comparisons are going to be relatively easy. But by the end of the year, you can be running at 8 or 9% year-over-year. And technology, it's going to slow. It can't do anything else but slow. So it's probably somewhere in the 15 to 25% range. It's still going to be good, but it's going to slow compared to what it was last year.
What sectors of the U.S. economy do you think are undervalued at this point?
Well, it's I guess the broad market is nothing really is undervalued in the U.S. market, quite honestly. I mean, you look at the S&P excluding tech, it's probably trading at around 16 to 17 times forward earnings. So it's not exactly cheap. And then, of course, the technology sector is relatively expensive. We would stick, for example, in the technology area to some of the kind of the household names. We're a little bit worried about Nvidia that the economic rent that they're getting out of their business right now is excessive. And that in a free economy, that doesn't last for too long. And actually, Microsoft, Intel, and others are trying to develop some chips for AI as well that are application oriented, and that they're really they're finding that Nvidia is going to have a little bit more competition going forward, and some of that excessive economic rent is going to wriggle out of that particular business. So I think technology is not necessarily not an area not to be in. We think that large cap technology is a place to invest in. but expectations have to be a little bit more modest as we go forward here. And also will evolve in terms of the AI spending. It'll evolve more towards software and cloud applications and less towards hardware, although hardware will continue to be an important component of it.